Today's topic is payroll, and payroll is a part of the expenditure cycle. A difference, I would say, about payroll and other expenditure cycle items, there are several differences. One of those is that with payroll, we really don't create a liability. Generally, we pay the payroll all in one step. So where we had our flow charting and we said the left side was creating the liability and the right side was the disbursement, in payroll, it's all generally done in one fell swoop, one process. The other thing different is under Learning Objective 3, where they have the impressed payroll cash account and what it is and how we use it. So it is a different feature. Unfortunately, in your SUA packet, they don't use an impressed payroll cash account. And it's easy to see that when we get to the point where we're actually paying our payroll, we'll be paying from the same account, same cash account at the bank, and the same general ledger cash account as our operating cash, and that's just not done. There are inputs that are into the payroll check cutting process, and we'll be using the payroll register. We will also be keeping track of the employee's pay, and we will also be doing a little bit of work in the SUA where we're looking at something that is similar to a database. The internal control activities in this cycle, you have to understand there's a lot of following the policies and procedures, and that's why I say the P in Peter is very important in the payroll cycle. The processes that we go through in the payroll cycle, first of all, it really starts when we recognize the need to hire a new employee, because someone has to authorize this, someone has to determine what the pay is going to be. Most positions, there is advertising, and if you advertise, you will probably find better employees than if you don't advertise. So advertising is really just a best practice. The human resources system is in place. I know here at Pitt State, we have a questionnaire which we fill out when we're interviewing potential employees, and we discuss their qualifications. Before we even decide to hire someone, we have to be able to come up with a list of qualifications or to discuss what sort of skills are needed for the job. And then we try to only hire the people that fit the requirements. That is to say, they fit what we would think that employee should be able to do. The pay terms for employees is another authorization process. You have overtime rules that apply, and these rules apply because of federal statutes. The benefits that are going to be paid, these come about because of the practices of the company. The company has rules as to how that they are going to be paying benefits, what benefits are going to be paid. Voluntary deductions are the deductions that the employee comes up with and says that they want taken out of their paycheck. These will be taken out of an employee's paycheck, and voluntary because the employee gets to make these decisions. There's other ones that are involuntary deductions, which are deductions that are taken out, for example, for Social Security. Now, when an employee's pay changes, the rate increase changes, or maybe they're going from hourly employees to salaried employees, these changes have to also be a part of the AIS because the payroll is being driven off of whatever rules or whatever amounts are in place for the employees. When employees are dismissed, there has to be a procedure to be followed there, and authorization of that, and then the retirement of employees, terms of retirement, and then of course there's the cutting of the check. The only type of liability you ever see really established, which has to do with the employee's pay itself, is the accruals, which are done at the end of the accounting period before you do your financials. Those are done so that the financials are correct. The amount which you accrue is not the amount that the employee is going to be paid. You're not going to cut a paycheck for that amount of the accrual. Instead, you are trying to do an accrual as an adjusting journal entry. So it's not the same thing as in the other disbursements we were talking about, where we created accounts payable and then we eliminated accounts payable by doing the disbursement. That's not it at all. You're simply accruing for wage expense or salary expense at the end of an accounting period in your accrual. That's a different sort of a liability. The employee's paycheck is calculated based on input from the operations as to the time they work. We use time cards. In the SUA packet, they're going to call it a little bit different. And then for salaried individuals, as long as they're continuing in employment, they will be paid the salary, whatever the salary is within the database. This payroll system has to be updated. So the AIS has to cover ways to change the deductions, the pay rates, all of that has to be amended when we have changes. The human resources system is going to provide us with certain information on the employees, and including if you have direct deposit, what bank account and account number and the routing number for the direct deposit. Approved payroll then gets processed on a predetermined periodic basis. By that I mean it's either 2 weeks, 1 week, 1 month. There is a set schedule that is followed where payroll is processed. And this is at the option of the company. It's another one of those things under the P of Peter where you have policies and practices in place, and the company just needs to be consistent and do it the same way always. There is, as I said before, the cash disbursement process is combined into one journal entry and not creating accounts payable. The other thing that's different here is having a separate cash account both at the bank and in our accounting records to process any payroll cash transactions, the payments that are going to the employees. You have this separate cash account at the bank, and you are going to be putting money from operating cash into this impressed. I know it sounds like it would be IMPRESSED, but it is IMPREST. This impressed cash account will get funded by transferring money from your operating cash into this cash account, and then when you write the checks to pay the employees, the checks will be written on this separate payroll cash account. So if an employee were to, change their pay from $1,000 to $10,000, for example, when it went through the system would create an overdraft in your payroll cash account pretty immediately, because you're not having any buffer in that account. The only money that you're putting into that account consists of the total amount of the net pay for the payroll for that period of time. You have to remember to put the money in there. That's very important. But it only has that amount in it. So you have to remember to transfer funds every time a cash disbursement out of payroll is going to be made. The internal controls and the payroll process, a lot of authorizations for pay increases, authorizations for hiring employees, authorizations of specific payrolls in terms of how many hours the employee worked, any changes that happen. There are lots of levels of authorization here. The segregation of duties is such here that you have certain individuals who are authorized to do different jobs, and you don't overlap those. So human resources that processes the hiring of employees shouldn't be the ones that have anything to do with paying the employees. So let me explain how this could be a problem. You work in human resources and you have a son or daughter who really needs money. So you process and put through an employee who happens to be your son or daughter, and then you process payroll and pay your son or daughter. So I guess you can see how this can be have potential fraud implications. It's really better to have direct deposit and not have to have any concerns about handling of checks. In the old days, you had someone called a paymaster, and the paymaster would have all the paychecks. I remember when I first started working many years ago, this is the way it was done. Someone, a very big, burly, strong security guard type person would have all the paychecks and go around and distribute those paychecks. And it was for security purposes. Often they'd ask you, show me your ID, show me your driver's license before they would even give you your paycheck. And when they gave you the paycheck, you would have to sign a document that said you received the paycheck. So this was the security that was in place with paychecks. With direct deposit, it goes directly into an individual's account. And so you avoid all of that custody of assets issue. Any change which you make has to be documented. There are pre-numbered checks, and the pre-numbered checks they look different from operating cash account checks. There's details on them. There's a pay stub which details information about that paycheck. Now with direct deposit, the pay stub still exists, but it doesn't go through the banking system. You will have to access it separately to see it. Payroll and human resources have a lot of records that have to be kept confidential. And one of the most important bits of it is Social Security number. So when you look at this SUA packet, you're going to see records with Social Security numbers on them. That's not done today. Instead, what we tend to do is we use employee numbers. Just like you have a student ID number, for example, you don't have Social Security numbers on your student IDs. Way back in the day, student ID cards had their Social Security number on it. Can you imagine that? I mean, really? So there's a lot of things that have to be kept separate, and there are legal reasons for these things, and there's just extra layers of protection when you get into things that deal with employees. There are independent checks and reconciliations that need to be done. The reconciliation is for the cash account, but you also need to be checking the calculations on the time cards. You need to be checking calculations whenever we have a change in federal tax rates, for example. You're going to see changes that should also follow through and should show up in your payroll system. This is an old example of how things were done. I have in red here to let you know accounts payable and cash disbursements. They're acting as if these are separate swim lanes, and really with payroll you don't have that. You have all of it combined. Notice down here There is under the cash disbursements lane that what we are doing is transferring funds to the payroll bank account before we actually cut the checks. They have management looking to see, do we have enough cash on hand? And if we have cash on hand, then you would today transfer the funds first before you would pay the employees. So there's this flow chart. I bring it up because I like to point out where the problems are. In the past, you could sign paychecks and you could keep these signed paychecks in a locked compartment, and then you could distribute them. And you see that down here because we have the paymaster column, and they're actually being distributed after the funds are transferred. But if you don't have the paymaster function and you don't have a mailing of paychecks, and you just have direct deposit, you definitely need to go ahead and transfer the funds to the payroll bank account before you actually have those paychecks distributed through direct deposit. I'm just going to point that out to you. Well, now you can go on and start work on 2 items in the SUA packet.